When it comes to managing your money, having a bank account is essential. But did you know there are different types of accounts designed for different purposes? Two of the most common types are checking accounts and savings accounts. In this video, we'll break down the key differences between these two account types so you can better understand which one suits your financial needs. We'll cover everything from how they work, to fees, interest rates, and when it makes sense to use one over the other. Whether you're just starting out with banking or looking to optimize your finances, this guide will give you a solid understanding of checking and savings accounts. Let's dive in. What is a checking account? 240 words. A checking account is a type of bank account that's designed for everyday transactions and bill payments. It allows you to easily access and spend your money through debit card purchases, online payments, written checks, and ATM withdrawals. One of the biggest advantages of a checking account is its liquidity. Your money is readily available whenever you need it. This makes checking accounts ideal for paying rent, utilities, subscriptions, and other regular expenses that require frequent access to your funds. Most checking accounts come with a debit card, checks, and online, mobile banking access for seamless money management. Many also offer overdraft protection, mobile check deposits, and other convenient features. However, checking accounts typically don't earn much interest, if any. The trade-off is easy access to your cash. They may also have minimum balance requirements, monthly fees, or other service charges depending on the bank and account type. What is a savings account? A savings account, on the other hand, is designed primarily for growing your money over time through interest. While you can still deposit, withdraw, and transfer money, savings accounts tend to have lower liquidity and more restrictions compared to checking accounts. The biggest advantage of a savings account is the interest it earns. Banks and credit unions pay you a percentage of the balance you maintain as an annual percentage yield, AP. The higher your balance, the more interest you'll accrue. Savings accounts are better suited for stashing money you don't need frequent access to, like an emergency fund, down payment savings, or long-term financial goals. The interest helps your money grow faster than sitting in a checking account earning little to no interest. However, savings accounts often have monthly withdrawal limits, minimum balance requirements, and lower accessibility. Dipping into the account too frequently could result in fees from the bank. But the trade-off is that higher interest rate. Key differences. Now that we've covered the basics of each account type, let's summarize the key differences. Access to funds. Checking accounts provide easier access to your money for daily expenses through debit cards, checks, bill pay, etc. Savings accounts are less liquid with restrictions on withdrawals. Interest earned. Savings accounts earn interest on your balance to help grow your money over time. Checking accounts earn little to no interest. Purpose. Checking accounts are best for everyday transactions and bill payments. Savings accounts are designed for setting aside money for emergencies and longer-term goals. Fees and requirements. Both account types may have minimum balance fees, monthly service charges, and other requirements depending on the bank. But savings accounts typically have fewer fees. Protections. Both checking and savings accounts at banks are insured by the FDIC up to $250,000 per depositor. Credit union accounts are insured by the NCUA. Which account is right for you? So which type of account should you use? For most people, the answer is both. A checking account acts as a hub for your daily spending, while a savings account is a powerful tool for building an emergency fund, saving for a house, retirement, and more. Here are some tips on how to use them together. Emergency fund. Set up a separate savings account earmarked specifically for your emergency fund. Aim to save 3-6 months worth of living expenses for unexpected costs. Spend from checking. Use your checking account for paying bills, debit card purchases, and everyday spending. This separates your daily funds from savings. Automate transfers. Set up an automatic transfer from checking to savings each pay period. Treating savings like a recurring bill makes it easier to build the habit. Short versus long-term savings. Have different savings accounts for short-term goals, like an upcoming vacation, versus long-term goals, like retirement. This keeps your money sorted. High-yield accounts. Shop around for high-yield savings accounts that pay higher interest rates than basic accounts. More interest equals faster growth. Only carry one card. Get in the habit of only carrying your checking account's debit card. This prevents dipping into savings unnecessarily. By using checking and savings accounts in tandem, you'll spend more intentionally from your checking account while simultaneously paying yourself first into savings. Your money will be organized, optimized, and working smarter for you. Call to action. There you have it, a full rundown on the differences between checking and savings accounts. While both are important financial tools, using them strategically leads to better money management. So take a look at your current banking setup. Are you making the most of both account types? If not, now is a great time to optimize your finances.